We're going to begin this video with a little refresher on the accounting cycle. Remember, we start by identifying the transactions from the source document. This might be a check, a deposit slip, invoice, a bill. We analyze that and determine how we're going to record it in our journal entries, in our financial records. Then we post it to our general ledger. From those postings, we prepare the unadjusted trial balance. We make sure that everything is in balance. We review that unadjusted trial balance for any adjustments that might be necessary at the close of the accounting period. We prepare those adjustments, post them to the ledgers, and then prepare another adjusted trial balance. Another trial balance, this one called the adjusted trial balance. From there, we prepare our financial statements. Those are used by our owners, our investors, our bankers, our vendors. And then next we come to the ending part of the accounting cycle. We'll prepare our closing entries. We're going to reset the accounts for the new fiscal year. We'll prepare a post-closing trial balance, the third and final trial balance that we prepare in the accounting cycle. Let's talk about these closing entries. That's our next piece of the accounting cycle. We need to reset the revenues, expenses, and the distributions taken by the owner to zero for the next accounting period. So at the end of our accounting period, which is normally the end of the year, we're going to reset the revenue, take it down to zero, reset the expenses, take that to zero, and take the owner's distributions to zero. We need to do that so that we can keep track of the net profit or net loss for every year that we're in business. I want to know how I did in 2016, in 2017, in 2018, etc. So I need to close those accounts out. We're going to use an account called Income Summary, whose sole purpose is for closing entries. This becomes the clearing account for closing those accounts, those temporary accounts that need to be closed. Income Summary moves that net income or net loss that we generated in that accounting period over to the equity section of our balance sheet, where our permanent or real accounts reside. We then close the owner distributions, either owner withdrawals or dividends, into that equity account. Retained earnings or owner's equity. Let's talk a little bit about those temporary and permanent accounts. Temporary or nominal accounts are those that are found mostly on our income statement. Remember, we want to see the results of our operations year over year. So we're going to close out the revenues and the expenses to zero every year. We also want to see what the owner has withdrawn every year, so we'll close the owner's distributions, owner's withdrawals, or dividends every year. The income summary account is a temporary account because it only serves the closing entries. We're only going to use it for closing entries. The sole purpose of that account is to close the accounts. So at the end of the accounting period, we will also close that account. The permanent or real accounts are those that sit on our balance sheet. Those are our assets, the things that we own, cash, accounts receivable, inventory. We can't reset those to zero because we own them. They have value. The liabilities, we still owe the bank, we still owe our vendors, those still stay there. And then the difference between those assets, what we owe and what we own, that's ours. That's what the shareholders own. That's what the individual owner owns. So that's the owner's equity. That stays. Those are our permanent accounts. The closing process only involves the temporary accounts, the revenue, expense, and owner's distributions. Here's a good look at the closing process. Revenues are credit balance accounts normally. To close them, we're going to debit them. That's closing entry number 1. Debit revenues, credit that account, income summary. Closing entry number 2 closes the expense accounts. All of our expense accounts are normal debit balances. To close those, we're going to credit each and every account and debit income summary. Now we look at our income summary account, and that's the third item we're going to close. So income summary has a difference between what was debited, closing the expenses, and what was credited, closing the revenue. That difference is the net income or net loss for the accounting period. Because in this case, revenues were greater than expenses, the $32,800 is greater than the $30,200 of total expenses, we had net income for the period. We're going to close that net income into our retained earnings or equity account. So we're going to debit the income summary, credit retained earnings, or capital, depending on what kind of entity our company is. Finally, we're going to close the owner's distributions. Those are either owner's withdrawals or dividends. In this case, we see dividends, so we're going to credit dividends, their normal debit balance, and debit the retained earnings or capital account. Note when we are finished with our temporary accounts, we actually do zero them out. We show the zero ending balance, double underscore, showing we're ready for a new year. Let's take a look at this adjusted trial balance from a problem we did in Chapter 3. The peach-colored accounts are your permanent or real accounts. The blue accounts are the temporary accounts that will be closed. So let's take a look at how that process works. First, we're going to close the revenue account. Closing entry number 1 closes revenue. If we take a look in the blue section, those are temporary accounts, right? Where's my revenue account? It's that fees earned account. So I'm going to go ahead and close that out. It's a credit balance, so to close it, I need to debit it. It's like subtracting it, right? If it's a credit, to get rid of it, I have to debit it. So debit consulting fees earned, 211,090, and credit the income summary account for the same amount. Here we're just going to say closing entry number 1, close revenue account. Closing entry number 2 is closing all of the expense accounts. So here we see all of our expense accounts. I've come in and started typing that up so that we've got that started. So here's all of my expense accounts. I've put them in the credit column because expense accounts are normally debits. To close them, I need to get rid of them by putting them in as credits. So the account that I'm going to debit, because we have to have equal debits and credits for every transaction, is what? The income summary account. So here I'm going to do the sum of all of my credits. And there we go. So I am now debiting income summary for $115,211.69. My third entry closes the income summary account. So if you can visualize, I've got a T account here. I've got $211,090 on the credit side, $115,211.69 on the debit side. Revenues minus expenses is my net income or net loss for the period. In this case, my revenues exceed my expenses by quite a bit, so I've got a pretty good net income for this accounting period. To move that net income over to the equity section of my balance sheet, I'm going to come in and I have to debit my income summary account to zero it out, right? Because it currently has a net credit balance. So I'm going to debit income summary for the difference between what I credited in closing the revenues and what I debited in closing the expenses. Now, if it were a net loss, we would wind up with a credit to income summary. So whatever we need to do to close out that income summary account. I'm going to move that into my capital account, which is M Prospect Capital. If you were a corporation, you would be putting it in retained earnings, 95,878.31. So closing entry number 2, we should probably put closes expenses, and closing entry number 3 closes income summary. And now we're ready for closing entry number 4. Closing entry number 4, remember, closes the distributions to the owners. So if we have any dividends or owners withdrawals, we now need to close that into our equity. If we look at our temporary accounts, we see that we have M Prospect withdrawals for $36,000. Well, I know I need to credit that, right, because it's a debit balance. So I'm going to debit M Prospect Capital, and that makes sense because we know that equity is decreased by owner's distributions. So this is our equity account. It's being decreased by $36,000, the amount that the owner withdrew. And our credit is M Prospect withdrawals. So closing entry number 4, close owner distributions. So if you had dividends, you would have debited retained earnings and credited dividends. That completes our closing entries. Once we're done with our closing entries, the final step that we need to do in our accounting process is the third and final trial balance, the post-closing trial balance. I've gotten that started for us. So here's my Prospect Consulting post-closing trial balance for the period December 31st, 2017. I have closed all of my temporary accounts, so the only accounts that I have left for this are those permanent or real accounts, the ones in the peach. So let's start bringing over the balances. Cash, so I've completed bringing all of the accounts over with the exception of that capital account. Remember, we closed out our net income or loss and the owner's distributions into that capital account. So for the post-closing trial balance, we need to figure out what is the balance of that account. So my beginning balance was $99.73.25. To that, I'm going to add the net income that I closed out, the credit to the capital account, the $95,878.31, and I'm going to subtract the debit that I did to the capital account for the owner's distributions of $36,000. That gives me a capital account now of $69,851.86. So if I closed my business tomorrow and my valuations were all good, the owner's equity would be $69,851.56. Now the moment of truth, we copy that over and see if our debits are equal to our credits. And I've got a 40-cent difference, so I entered something wrong. I think I probably entered it wrong in the closing entries, but you see the point, and I'm not going to go back and find that at this time, but there you go. Your accounting professor is not perfect either. So that is the end of our accounting cycle. That concludes the accounting cycle when we've done the post-closing trial balance. Let's take a really quick look at the classified balance sheet that's discussed in your textbook. So what I want you to see here is a different way that we approach the balance sheet. What we're looking at here is we're classifying or sort of sorting the balance sheet into some different categories. So we're looking at our assets, we're sorting them into current assets, those that will convert into cash, be used up within the next 12-month period. Those are our current assets. So here we can see our cash, our short-term investments, accounts receivable, inventories, our prepaids. We expect all of those to either be used up or to turn into cash within the next 12 months. Our total current assets are $450,000. Then we see our long-term investments, those that we're going to hold for longer than 12 months, our stocks, maybe the cash value of our life insurance. Next, we have our intermediate assets, the property, plant, and equipment. It's our land, our buildings, all of our equipment, less the depreciation that we've taken. And then intangible and other assets are rounding out the bottom to get us to our total assets. On the liability side, we have our current liabilities. Those are the ones that will be paid or due within the next 12 months. So notice I've circled the current assets minus the current liabilities. The difference between those two numbers is called our working capital. When we pay all of our current liabilities with our current assets, how much working capital do we have to put back into our business? And in this case, it's a pretty good number. It's $300,000. So we also can do the current ratio, which is going to be the current assets divided by the current liabilities. So 450,000 divided by 150,000. This company has a 3-to-1 current ratio. That's good. That means that they can pay their current liabilities, what they owe people, 3 times over with their current assets. So in most cases, we always want that to be greater than 1-to-1. Less than 1-to-1 means that you cannot pay your current obligations with the assets currently available. After that, we have our long-term liabilities, those liabilities that will take more than 12 months to repay, and